Hello and welcome to the What the Finance podcast, where we talk to experts about all things finance. If you get value out of this episode, please subscribe so you don't miss out on any in the future. I hope you enjoy.
So Trishul, so thank you so much for joining the podcast today. I was reading your bio and it's quite interesting. You've been responsible for sort of managing an exotic options book in Southeast Asia. I think it said it was responsible for sort of $750 million in revenue over 3 years and portfolio manager for a hedge fund. Can you talk more about these experiences in your own journey?
Yeah, happy to. Just stepping back a little bit, I started investing maybe 15, 20 years ago, and I really liked the space, although my education was an engineer.
Okay.
It didn't matter anyway because I joined a firm doing financial consulting right out of engineering school. But I got into investing, I really enjoyed it, wanted to do it full time, learned everything about it, and went to business school for that, got my MBA, and then started thinking, okay, what now? And the reason I got into the quantitative space on the investing side is because you combine engineering and finance and you start working through these types of models and stuff, and it seems like a pretty good fit. So that's how I kind of ended up in Southeast Asia. So out of business school, I started building my own models, trying to come up with different pricing methodologies and algorithms to look for market inefficiencies. And I just started pitching it to anybody who would listen. And I got on the radar of this firm out in Southeast Asia that was pricing options. So I had a couple chats with the CEO. We did the whole Skype thing and it ended up being a good fit. So that's how I ended up out there. I ended up managing the entire quantitative team for the business. And our job was to come up with prices for options and then sell them. And the goal there is to come up with a price that's fair. If you charge too much, nobody's going to really buy them. If you charge too little, well, then you get hosed. You'll just lose money. So coming up with a fair price of all of these different types of instruments opened my eyes to a global market because we were pricing options on markets all around the world. And we were looking at different markets like currencies, commodities, stocks, indices. So just a lot of different things going on, but it was all automated and systematized, and it was a great experience.
Yeah, definitely. That's quite interesting. So was that mainly focusing on emerging markets or just all markets around the world?
All markets. We just happened to be based in Southeast Asia, but we could trade anywhere. We can price instruments as long as we get data feeds and stuff like that. We can come up with our algorithms and come up with a fair price and just kind of put it out there and see who wants to pay for it.
Yeah, it's interesting. And then obviously, when was this? Was this a few years ago or?
Let's see, this is probably between 2011 and 14.
Okay, sure. And have you seen sort of algorithmic trading, and I guess that sort of thing? Have you seen that advance quite a lot since then?
Oh yeah, certainly. It's gone through many generations. So traditional option pricing, Black-Scholes, going back to like the 70s and whatnot. But there's always been evolutions, from one step to another. Black-Scholes had a lot of shortcomings, a lot of assumptions built into it, and soon they started to add like fudge factors to try to make the models a little bit more competitive and realistic. And then after that, they started to add horsepower by using like Monte Carlo simulations and stuff like that to be even more competitive. And yeah, probably state-of-the-art models. They use just a lot more complexity, math, and speed and horsepower for sure.
Yeah, so you say now it's a bit more efficient, the market. Obviously, there's less opportunities.
Yeah, I would say so in general, even beyond options in the equity space as well.
Yeah, perfect. And then for yourself, so when you're investing, do you look at all markets as well? Do you mainly focus on emerging markets? What's sort of your philosophy?
Well, my high level philosophy is essentially passive at this point. So I did have a hedge fund stint after the experience out in Southeast Asia. I worked with a hedge fund to get it going, launched it from the ground up, ended up with nothing and rose it to over 100 million. And we did spend a lot of time trying to look for these types of market inefficiencies. And it's a very tough game to play. That's certainly a large part of what I've learned. But for a long-term tried and true strategy, getting that market return is not so bad at all.
Yeah, definitely. And so you'd say now it's more passive, just obviously long-term, focusing on the. I think a key thing that you mentioned is also the FIRE sort of initiative. So I don't know if you want to expand on that more as well.
Yeah, happy to. So the high-level notion with FIRE, financial independence, retire early, is that if you get your savings rate up to a pretty high percentage of your income, it's possible to shave off the amount of years that you need to work until you reach financial independence by quite a bit. And the average American household saves maybe 5-6% a year. But if you can bump that up to 10, 15, 20, 30, 40, 50, you could start shaving decades off how long you need to work before you reach this type of financial independence. And I started looking at some of these numbers and analyzing how that might fit my personal situation, way back like 20 years ago. And I kind of realized, well, geez, I don't have that high amount of requirements when it comes to spending. And I found that I could potentially save 20, 30, 40, 50% of my income. You do that over, a 10, 15-year career, and you can make a pretty big dent in how much you put your money to work and build up a nice nest egg. And then once you get to a point where that nest egg is producing enough income to cover your expenses, that's kind of it. Then it's a whole different ball game. And that's kind of what I was able to do, a couple years ago.
Yeah, definitely. So that's interesting. So, getting to the point where it's producing enough residual income to cover obviously cover yourself so you don't have to work if you don't want to.
Yeah. And, it's one of those things where it's not like I don't want to work, but working becomes optional. So it kind of opens the doors to do things that you wouldn't always consider or you wouldn't put at the top of your priority list because, there's other financial motives that keep you doing other things. So I think that's what it's kind of done. It's opened up opportunities for me to be a lot more flexible and a lot more opportunistic with my time.
Yeah, and do the things you want to do. So say, I know you have your own podcast and obviously your own sort of financial freedom consulting as well. So those are more of the things you want to do rather than other stuff.
Yeah, for sure.
Yeah, definitely. Awesome. So you mentioned sort of, as I said before, you're a financial freedom coach helping others. What would you say is the quickest way to sort of become financially free? Was it just saving as much as you can?
Yeah, it helps to have a high income. It helps to get the debt out of the way. And that certainly helped me over the years. And I did have a head start. I had my parents help me out with my education. And it's something that gave me a big head start. It's something that I'm paying forward to my daughter, but it does make a big difference. But I'd say beyond that, the two big things that I like to concentrate on with my clients is getting that savings rate as high as possible. That's something that just makes so much of a huge difference. And then the second part is just investing those savings as sensibly as possible from two perspectives. One, I think having that passive return that tries to match that market return, get the most out of the return that the investments provide in the market is a good thing to do. And the second thing to do is to get those investments as efficient as possible from a tax perspective. There's many ways to do that as well. And I think if you concentrate on the savings and the investment side, that's kind of it.
Perfect. And then with the sort of the passive returns, you focus more on obviously dividend stocks, or is that sort of what you mean? Or maybe real estate? Are those the things you'd focus on?
Not necessarily. So what I like to say is you want to look at the total return. So if you focus on dividends, then you might be giving up capital gains. If you focus on just growth, you might be giving up dividends and so on. But look at the total return. Look at the entire return you can get across all the different ways that you can get income from a stock. Capital gains, appreciation, and dividends. If you look at that entire total return, what you probably realize is just a passive portfolio that's globally diversified. That's something I do try to make clear, that it does make sense to provide an allocation that's spread out across the entire globe, because I personally feel one single country doesn't have a monopoly on actual returns. They might have an edge on performance, but that would be priced in. So then the actual returns shouldn't be superlative on an ongoing basis indefinitely. So that's what I kind of say at a high level when it comes to the actual portfolio. And it's generally stocks and bonds, and real estate could be there, but generally people have real estate because they own a home, and other various ways it does kind of sneak in anyway.
Yeah, perfect. And then for them to sort of invest internationally and in other markets, would that be through ETFs, or would that be the main way?
Yeah, ETFs are a great way to go about it. At this point, there's been a drive to zero in terms of cost for most of the passive indices, and I can get 20,000 securities invested in a basket of ETFs around the entire planet it's very cheap these days. So it's certainly a efficient way to go about it from a cost perspective and from an execution perspective.
Yeah, especially if you don't have as much experience in terms of investing, it makes it a lot easier, doesn't it?
For sure. And, what I might kind of tag on to that is I've seen a lot of people with a lot of experience do no better.
Yeah, I'm sure that's what they say, isn't it? Most of especially after fees and everything included, a lot of the time the returns aren't better than a lot of the ETFs.
Yeah, there's a lot of research that does point in that direction, that it's kind of getting harder and harder to eke out that edge, especially once you compensate for all the different things. Fees are a big one. Also, for the fact that if that strategy is a little more active, it's probably going to have a higher tax burden as well. These things do erode returns over time.
Yeah, definitely. So for any of the financial sort of professionals out there who are a bit more experienced in investing, obviously you have a lot of background. What would you sort of recommend for them if they're maybe more, high volume traders and stuff like that?
Well, okay, so I think there are probably anomalies out there that you could still monopolize on. There's two components though. One is if you're an outsider and you're paying somebody to give you free money, to beat the market, you're going to probably have to pay a lot, and you're probably going to pay as much as you're going to get, meaning you'll probably be back to where you started. But, if you're on the inside and you feel like you have some sort of specialty, I still try to say that it might make sense for it to be closer to, not the bulk of your portfolio, but, a slice of your portfolio that you feel comfortable with, so that it's not, driving the whole trade. So that's kind of what I recommend, even for the experienced traders. And, for myself, I do understand that there could be some strategies that I have personal experience in. I've been pretty heavy in some of these smaller markets in terms of my professional experience. And I get it, there could be some there, but I personally wouldn't do more than a large share of my pie. It would be a minority.
Yeah, okay. So then that way you have, small percentage, 5-10% maybe maximum of the high risky assets, but then that's balanced out by the other investments essentially.
Yeah, that's right.
I guess it depends on obviously people's risk, how much risk they want to actually have in their portfolio as well.
Yeah.
But an interesting, I saw an article you wrote, which was quite interesting, and it was sort of talking about monetary policy and whether governments can just print money forever. I'm not sure if you can go more into that and sort of what you found from researching that.
Yeah. I cover a wide range of topics, and sometimes I get a little deep into some areas. And, that's something that I've been thinking about in general. What happens with a lot of the fiscal spending, especially over the last, year or two with the coronavirus. And there is concern, are we just spending our way out of this, and then is it going to catch up with us? And, what I always like to do with some of these things is try to normalize the data that we get and try to put into context of the longer history. Because you hear some numbers, 3 trillion in spending, 4 trillion in spending, and it's scary. Those are big numbers. But, you try to put into context, one good metric is maybe look at that spending as compared to GDP. And, this is something you can look at over longer histories and say, okay, are we at screaming horrible levels? Are we at the tipping point of, past the point of no return? And, just looking at some of that data, you realize a couple of things. Yeah, it's high. We did spend a lot, and our debt is very high compared to GDP. It used to be, comfortably in the 70 to 80% range. Now we're well above 100. The question is two things. One, it is possible at a high level to grow debt, but still not have it become a huge issue if the growth in GDP can accelerate past the growth in debt. It is possible. The other thing to realize is if you're borrowing money like the government does for lower than the inflation rate, you're actually borrowing for free. It's not a completely free lunch for a couple of reasons. I don't think the government should do this, without some caution or a good amount of caution, because at the end of the day, if you're borrowing and not investing in something that produces more growth, then you're not really accomplishing what you intend to. But if you're able to borrow at close to 0% and the inflation rate is 2%, well, after a generation, what that basically means is your debt is cut in half if you didn't grow at all, just by inflation alone. So it's something that you want to keep in mind, but you want to keep those numbers in mind in terms of the larger context. And my personal feeling is there's a lot of debt out there. It's not terribly horrible, but if we can use the debt responsibly to accelerate growth, then hopefully we can come out of this and it should be okay. And again, it's down to how responsible can we be with using those funds in a manner that actually helps us in the long run.
Yeah, definitely. I think a key thing is sort of obviously keeping inflation under wraps so it doesn't get too high, which I think is a big concern. And then, if it gets higher, then you have to increase interest rates, and that would then increase sort of the bill that would have to be paid.
Yeah, that is a big thing. I'd say we're a little lucky now that we can kind of get this little free lunch here, and it's something that we shouldn't bank on for the long term. But it's something that if we're cautious on how we do this, it could help us overall. It could help us overall because, not spending that money, getting stuck in a rut for the economy and getting the gears grinded to a halt could lead to a far worse situation. So there's a balance here. There's no one right answer. But it's not to say that it's in the end of the world because we did have to spend our way out of this particular scenario.
Yeah, I guess that could be sort of deflationary situation similar to what we saw in China in sort of the 90s and the last 20 years, couldn't it? If it didn't have the inflation and didn't have the growth and no spending.
Right.
And then sort of for investors, how would they be able to, take advantage of this? As you said, it's sort of a free lunch. How can we take advantage?
Well, okay, so a few things. I don't know which way the markets are going to react to this type of thing. They've always been super happy with the free lunch for our entire generation, essentially, right? We've had periods of a good amount of spending by governments, a good amount of easing whenever markets go down. So it's been highly favorable. Of course, at the same time, what we've seen over this past generation is that debt has increased and there could be a tipping point. So we want to keep that in mind. At a high level, are there any sort of tactical plays that I would recommend because of this? I really can't say, to be honest. I don't know if I'm in a position to be able to predict how you might be able to capitalize on it. But I do still think, though, my end conclusion is getting that market return is still a sensible thing to do. It's not necessarily a scenario where we should be going to cash. I think sticking with it and coming up with a long-term strategy that fits your personal risk profile is something that still makes sense. I think that's where I come out after this type of analysis.
Perfect. And so obviously you mentioned sort of saving quite a lot of money. Would you sort of put say 3 months of it sort of costs aside and then invest the rest? Is that, obviously this isn't financial advice, but it's sort of for the regular person.
Right. Well, the way you want to think about an emergency fund is, 3 to 6 months is quite typical. Now, you want to be closer to the 3 months, or it might make sense to be closer to the 3 months if you have less things to worry about. If you have a stable job, fewer dependents, no major expenses on the rise, and good health, things like that. However, you might want to be closer to the 6 months if you are, with a family and you're the single earner, you have multiple dependents, some health issues on the horizon. So it depends on where you kind of feel comfortable. And beyond that, it does kind of make sense to put that other money to work, because if it's kind of sitting there, there's an opportunity cost. It's not working for you. It's probably working against you.
Yeah, especially if inflation continues to rise, it's just sort of losing the value you can buy with it.
Right.
Yeah, perfect. So I saw something that where you mentioned sort of how Wall Street, they have sort of an advantage over obviously regular investors. So what would you say that advantage is?
Well, okay, so it's interesting because you would think that with all the sophistication that Wall Street kind of brings to the table, that they should be able to provide superlative returns, right, to their investors. But I think there's little evidence that says that. I think the advantage they have is that they have the information to understand the complexity behind the products that they're selling. And it's tricky for a novice investor to understand that. One thing I like to say to my clients is that if you don't understand what you're investing in, it likely doesn't make sense for you. And these things can get quite complicated. So I think that informational advantage is on the side of Wall Street. And, at the end of the day, a lot of the way that Wall Street earns money is through fees, whether it's through bigger M&A transactions or bringing companies public, or, trading, or even, other types of transactions and margins and stuff like that, or just the fees that are baked into the financial products. So at the end of the day, the reason they're charging these fees is two reasons. One, to be a broker, which is great. You need something to be a middleman behind all these transactions. But the other reason is, selling performance. And, it's that second reason where it seems like there might be an informational advantage that kind of leads to that. And I think if there's a good understanding of what's really going on with some of these products, there might be less of that.
Yeah, it's interesting. So obviously, if someone's looking to invest in the product, make sure they have a complete understanding of it. And I guess sometimes it's easy just to, we've seen with AMC or with Bitcoin, it's easy just to jump into things because you think they have a high return. But, hold back and do your research before doing that.
Yeah, and it's one of those things where sometimes with a financial product, you have like the engineers or the tinkerers in the back end, or the mechanics who are building the products. But then 2 or 3 stages down, you have somebody selling the product, and then you have a retail investor, or maybe even a sophisticated institutional investor purchasing the product. But there's a lot of information gap that might get lost along the way before you get to the end of that supply chain. And at the end of the day, does that person even selling that product fully know it as much as the person who built it? And it's tricky. These things do get very complicated very quickly.
Yeah, and especially with, as you said, the structured sort of assets and things that are inside investment banks and other of those massive institutions, they can be so complex. And I think we saw that in 2008, where people just didn't understand what was happening.
That's very true. Being in the option space, for example, one thing to realize is it's a zero-sum game. And if I'm going to be selling an option, I need a little bit of premium, meaning if you're continually buying options, it's tricky to make money that way unless you have a true edge, and that's hard to do. And that works with a lot of different financial products.
Yeah, and I guess the edge is about how long it can last as well, because how long until someone else discovers it, and then you have to find your next edge.
Yeah, it's a very tough game to play, and I'd argue it's getting harder and harder.
Yeah, I would definitely agree. So sort of when looking at the markets and lessons that you've learned, what would you say, the greatest lessons are that you've learned from the markets?
I think it is frankly that notion of staying passive, because there's a good amount of research that says that when individual investors, and even professional investors, frankly, they try to go out and beat that market return, they end up giving up along the way. And it doesn't sound like much. If the market's getting 10% and you get 8%, over 10 years, you say, great. But that 2%, it adds up. Over a lifetime, you might be leaving half your money on the table. That 2% could be compounding in your pocket instead of Wall Street's pocket. So it could make a pretty big difference. And I started to realize this early on. I've been indexing for a good part of my investment career. And I realized initially when I was investing in stocks, and I was trying to beat the market, and I was trying to follow a very rigorous fundamental strategy, I think the biggest lesson I learned is over time, I started realizing, hey, that passive portfolio is doing a lot better than my active. And, I started doing less of the active, more of the passive in my personal portfolio. And I kind of kept those stocks around as the biggest reminder of my life that, hey, this is hard. This is really hard to do.
Yeah, definitely. And I guess if you look at the past 20 years as well, it's been in such a great market for, as you said, passive investors.
Yeah, for sure. It's one of those things where, yeah, if you have a lot of zigging and zagging and a lot of stuff like that, 2008 was probably a much better opportunity than every year since then to do a more active type of strategy. So frankly, I think, again, the competitiveness in the market isn't going down. Computers and algorithms aren't getting dumber. So I don't think it's going to get easier.
Yeah, definitely. And you sort of mentioned about, making sure your taxes, you can reduce the amount of tax paid and or making it more efficient. But I guess the same thing goes once you sort of, if you're, constantly getting out of trade, you have to pay the tax straight away. And it's the same with the compounding and, the actual money that you're losing over the long term.
Yeah, that makes such a big difference, because if you think about it, if you're paying that short-term rate, that higher tax rate on all of your trades every year, to match that market return of, let's say 7%, you got to earn 10. And that's hard to do. Now you got to overcome a lot of friction in your taxable accounts to kind of make something like that work. And I think something like that kind of gets overlooked sometimes, because you see that 10% in your, brokerage account, and you pay the taxes out of your bank account. So you may not make that connection immediately, but there's an opportunity cost there.
Yeah, definitely. And then obviously you said you worked in Southeast Asia, and there were sort of quite small markets. Are there any emerging markets that you yourself are watching out for?
Well, so I've been invested in emerging as a good chunk of my portfolio going back 10, 15 years. And that's just because I realize, again, that it's good to be globally diversified. I know there'll be higher risk. And frankly, over that period, the returns have not been as good as the more developed markets. But it's one of those things where I don't know what the next winner is going to be for the next 10, 15 years. So I'm just equally diversified across all of these emerging economies. I realize, in the long run, or I surmise, I would say, that the global economy, I really hope over the next 30 years is going to do well. And if it doesn't, I think we're in a bigger issue or bigger rut than, we have anticipated than our bank accounts and our investment portfolios.
Yeah, definitely. So, and that's the way to look at it, isn't it? That, make sure that you're diversified worldwide, because if it doesn't go that way, then it's going to be negative anyway.
Pretty much. That's kind of how I see it. And, the US has had a great run for the past 10, 15 years or so, but you look at it for the 10, 15 years before that, there were plenty of periods where international did better. And that kind of goes back and forth. Now that makes sense as well, because why should one country be able to get higher returns, not higher performance, higher returns than every other country? It doesn't make sense. People would just say, hey, look, US always gets better returns. Let's buy that up. That efficiency should go away pretty quickly.
Yeah, definitely. I guess you can say the same, but obviously there's growth versus value investing at the moment, and there's sort of companies where you'd say there'd be changes in that as well, and the trends happening there.
Yeah, you can kind of make the same argument I just did for growth, value, small, big, however you want to slice it. But you would think that if there was something perpetual or simple like that, it should kind of be taken care of by market participants.
Okay, perfect. So, sort of, I know you mentioned the importance of passive income and sort of compounding. Is there any other advice you'd give to young investors, sort of for them to become financially independent?
It really, that savings rate and taking that money and putting it into shelters. So there's so much you can put away, maxing out your 401k, your IRAs, figuring out how you can get most of that money in a tax advantage account, I think is the most sensible thing you can do. And just kind of let it grow over decades, and you'll be surprised. Just matching or maxing out that $6,000 in your Roth over a 30-year career, you'll end up with $1 million. I mean, it's not hard to do if you start early. If you're in your 20s, that's the most important advice I would give.
Yeah, perfect. Start early, and then hopefully see the good stuff later.
Yeah, that's right.
Perfect. So, Trishul, thank you so much for sort of joining the podcast today. Just on to my last question. So, is there any other message you sort of leave to the audience, or what is one message you'd like them to take away?
Well, beyond that savings rate and the investing sensibly, I'd say what's really important in somebody's life is just not their bank account, not their returns on their investment portfolio. Our most precious commodity is our time.
Yeah.
So what it really means is, what I like to focus on is not financial freedom, but time freedom. It's the one resource that you can't grow it. It's a finite resource, and how you use your time is going to mean more to you than how you use your money in the end.
Perfect. I think that's great advice. So, yeah, thank you so much for doing the podcast. If anyone wanted to get in contact with you or sort of see more of what you do, where would the best place to do that be?
Yeah, you can check out the podcast, mindmoneyspectrum.com, and the website is investingforever.com. Thanks, Anthony.
Thanks, mate. Cheers. Appreciate it.